Everyone. Next up, we have Yorkton Equity Group Inc. It trades on the TSX Venture under the symbol YEG and is a fully integrated, growth-oriented real estate investment company committed to providing shareholders with growing assets through the accretive acquisitions, organic growth, and the active management of multifamily rental properties. Please welcome its corporate development, Liyanage. Welcome, Rej.
Thank you. Thanks for the introduction. We'll play a short video. It's basically who we are, what we do, and then after that, I will do the PowerPoint presentation.
Yorkton Equity Group, YEG, is a growth-oriented real estate investment company committed to providing shareholders with growing hard assets and stable income through the accretive acquisitions of multifamily residential properties. YEG deploys an aggressive acquisition strategy guided by our conservative investment philosophy and strong financial management, with the objective of providing shareholders with growing net asset value and earnings. YEG is built on the solid foundations of the Yorkton Group of companies with strong financial capacity, having been in business for well over 30 years. YEG has an outstanding board of directors and management team with strategic vision and extensive experience in the real estate field. Yorkton Equity Group, poised for secure, stable growth to deliver an outstanding value proposition for shareholders.
So tell a little bit about Yorkton Group of companies. Yorkton Group has been operating since 1989, and the Yorkton Group has done everything from construction to condo conversions to land development, redevelopment, commercial leasing, commercial brokering, hotel operations, etc. We felt that the next evolution of the Yorkton Group of companies was to have a public company, and we set up the Yorkton Equity Group in 2020, November. So we have been trading for about 7 months, and in those 7 months, we have done, we have progressed tremendously. We have done 5 significant real estate acquisitions, which I will be covering during today's presentation. So today we have an unprecedented opportunity to invest in real estate. We're anticipating the post-COVID-19 boom, and right now we have the perfect storm, if you will, in terms of opportunity to invest in real estate. We have historically low interest rate, as low as 1.5% CMHC insured mortgages that we can utilize when we buy apartment buildings. We also have significant migration expected to come to Canada over the next 5 years. This year, federal government announced over 400,000 immigrants, and most new immigrants, they rent before they buy. And so perhaps for the next 3 to 5 years, we're going to see a significant migration of population into the rental market. We're also seeing greater supply of apartment buildings that we can buy because as a result of the post-COVID-19 situation and some of the frustrations that owners have felt as a result of the pandemic, we're seeing greater supply of product on the market. Okay, so low interest rates, greater supply of product on the market, increased immigration levels, all of that is going to significantly benefit the rental business. Okay, and the Yorkton Equity Group is strictly focused on buying and holding investment grade revenue properties. Okay, and one more point that I want to emphasize before we move on is the Yorkton Equity Group is not a REIT, and we have no intention of becoming a REIT at this point in time. The reason is that REITs typically have to pay out 90% of their pre-tax income as dividends. In our case, we want to reinvest our profits back into buying more and more multifamily rental properties in strategic markets. Our objective is to continually increase the net asset value of our portfolio as well as the net operating income. Our current focus is British Columbia, in primary and secondary markets in British Columbia. So we like places like Vancouver, Victoria, Kelowna, etc. Now, over the past 30 plus years, as I mentioned, we've been operating as a Yorkton Group of companies since 1989. But in fact, we bought our first apartment building back in 1984 and 1985. So the property management team of the Yorkton Group of Companies will be managing the properties of the Yorkton Equity Group. And over the years, we've developed some criteria on the acquisitions. So for example, we buy properties with at least 1.15 debt service coverage ratio. We also like to keep the indebtedness of our entire portfolio to be less than 70% of gross book value. And of course, we operate under a risk-averse business model. And we expect the low interest rate environment to be here for the next 3 to 5 years. We may see some small increases, but we don't expect any major increase in the interest rates. And even if interest rates do go up, we know how to deal with higher interest rates because, as I said, we bought our first apartment building into our portfolio back in 1984, 85. So we've seen many ups and downs in terms of interest rates. So whether the interest rates are low or high, we will adapt and we will succeed as we have in the past. This is one of the properties in the Yorkton Equity Group portfolio. This is called the Pacific Mall project in Edmonton, Alberta. This property is now 100% owned by the Yorkton Equity Group. We have HSBC as a long-term anchor tenant. This is a 2-story covered mall. We also own the parking lots behind the mall. This whole property was rezoned back in 2014 into a $200 million development with shopping mall and up to 38-story twin towers. Now, because Yorkton Equity Group operates under a risk-averse business model, Yorkton Equity Group will not be building these towers. However, we may hold this property for the next 5, 6, 7 years, enjoying the $500,000 in net operating income that we bring in on this particular property. Perhaps after 5, 6, 7 years, we will sell the properties, and the profit generated we will utilize to buy more multifamily rental properties to expand our portfolio. Another recent acquisition is a property in Langford, Victoria, in Greater Victoria. This is a 16-unit apartment building with 1 commercial unit. And this building was built in 2014. It's fully occupied with a waiting list to get into the building. So very strategic acquisition. This is in the fastest growing Greater Victoria area, the city of Langford. Incidentally, the city of Langford was named last year as the most livable city in all of Canada. This property is located right in the city center of Langford, which is in Metro Victoria. Another recent acquisition is the Larson Place Townhouse Project in Kelowna. This is a 19-unit upscale townhouse project. Each of these units in this property has its own backyard as well as 2 parking stalls. It's fully tenanted. The cap rate is 4.33%. We were able to buy this property below the market. We were able to buy this property for $468,000 per door, whereas the market price is $675,000 per door. The rent being charged in this building is also in this complex is also below market. Current rent is around $2,000, whereas the market rent is $3,000. The reason why we were able to buy it at such a low price per door is because we bought it directly from a builder, and builders typically want to exit as quickly as possible their project to reuse their capital. Based on $468,000 per door price per unit, the acquisition price was $8.9 million. Okay. Based on $675,000 per unit, based on the current market price, this price here would be around $12 million. So the Yorkton Equity Group has already pocketed about $3 million in value based on this strategic acquisition. Kelowna, as you may know, has a very strong economy, growing population. It has a booming real estate market and international airport. Another recent acquisition is the Yorkton Equity Group's 25% interest in the Yorkton 108 project. This is a 193-unit purpose-built residential apartment condo. This project has not been built yet. However, Yorkton Equity Group has acquired a 25% interest in this project, and currently we have offers continually coming in to buy this project. So if we end up selling this project, Yorkton Equity Group will realize a substantial profit. Here's an example of this was a related party acquisition. Here you can see an example of how the Yorkton Group buys property and increases its value by rezoning land. Okay, so this property here, Yorkton 108, was bought by the Yorkton Group of Companies for 8.1 million. And we had it assembled into a development project, and we had it appraised at 12 million. After the third reading rezoning approval in December of 2020, we had it appraised again at 21 million. Okay, so the Yorkton Group of Companies is very good at rezoning properties to achieve higher density and higher value upon disposition. And we perhaps 10 to 20% of our portfolio of rental buildings, we will look to rezone to higher density so that we can sell, earn extra cash to, to buy more and more apartment buildings in the Yorkton Equity Group portfolio. Another recent acquisition is the Riviera Gardens in Edmonton. This is a 62-unit strata-titled residential condominium complex consisting of 2 4-story buildings on 2 acres of land. This is, again, a very strategic acquisition. This property is located just 5 to 10 minute drive from all the big box stores in Edmonton, like the Home Depot, Best Buy, etc. It's also just a few blocks away from the River Valley. This project, obviously, with 2 acres of land, this would be quite ripe, perhaps in 5, 6, 7 years, to rezone to much higher density and sell and earn extra profit for the Yorkton Equity Group. Here you can see the share price movement. We had our market open ceremony on January 27th. And as soon as we announced our business model to the world, you can see the stock price shot up to 35 cents. And then it went again up to around 45 cents before settling for the day at 44 cents. And between here and here, we had no news announcements. Right over here, we announced our 25 cents private placement was announced here. And you can see that there was some profit taking. Also, the pre-listing private placement 4-month hold ended here. And again, you can see some profit taking as a result. But you can see the price recovered quite quickly, and it's been steadily rising. And for the last 2-3 weeks, it's been trading at 35 cents. Yesterday, it closed at 35 cents. So we're quite pleased with the price action of the stock. The story of our company is just getting out there. Okay, it's just getting out there where we have an engagement with Stockhouse as well as other marketing entities. So the word is just getting out there, and as the word gets out, we expect the price as well as the volumes to increase. Just a point to make: those investors that came in on our pre-listing private placement have already made over 70% return on their money. Okay, because they came in at 20 cents, and today, if they were to dispose their stocks at 35 cents, that's around about 75% return on their investment. So they're doing quite well. So we have a current non-broker private placement open at the moment. We're raising $2 million. The offering price is 30 cents per unit. It comes with each share that you buy comes with a 45-cent warrant with an 80-cent acceleration clause. Okay, and these shares are RESP, RSP, TFSA, etc. eligible. Our management team, Bill Smith is the chairman of the board. Bill Smith is a very seasoned senior officer of a number of public companies on the TSX Venture Exchange. And he has the distinction of being mayor of Edmonton not once, but 3 times. Ben Louis is our CEO and director and founder. Mr. Louis graduated from the University of Toronto with a Bachelor of Science degree majoring in computer science, as well as a commerce degree. And he has a lot of experience in many different industries. He bought his first apartment building around 1984, 1985, and he's been very successful in real estate. These are some of the previous projects of the Yorkton Group of Companies. Just to give you an idea, you can see all these apartment buildings that Yorkton Group has been buying since the mid-1980s, and you can see some of the returns that we have achieved for our stakeholders. Okay, this project here was another buy, rezone, and sell. All the investors, including the investors that were in it for 3 to 6 months, they all walked away with 20.45% return. This project was located in the city center area of Surrey, just to the south of that city center, in fact, in the Newton area. Okay, and this again shows how Yorkton Group of Companies is very good at buying, rezoning properties to higher density to achieve significant earning potential. Okay, so why invest with the Yorkton Equity Group? We have a common sense business model. Okay, it's not rocket science; it's common sense business model. We buy up, we buy up properties as I've showed you, and the tenants are constantly paying down the mortgage. As a result, the net asset value is continually increasing, as well as the value of the buildings as those mortgages get paid down. Leverage in real estate is very important. With a 25% down payment, a mere 25% increase in property value results in over 100% return on investment. And especially in the Vancouver area, real estate prices have gone up quite substantially, as you can see from this graph here. Okay, so a property that was perhaps about $1 million in 2010 would be worth close to $2 million today. In 10 years, it's more than doubled. Okay, and as I mentioned earlier, our focus is British Columbia. We like the Vancouver Lower Mainland, as well as places like Kelowna and Victoria. We have a very efficient business model. Every 5 years or so, we can take out equity tax-free to buy additional properties. We have a hassle-free investment model. We have an experienced management team with 30 years of experience, over 30 years of experience in the Yorkton Group of companies managing the properties in the Yorkton Equity Group. We have a very solid business model because accommodation is a basic life necessity, as well as a hedge against inflation, especially these days as currencies devaluate. We intend to have a diversified portfolio of properties, both geographically and by product mix. And we like to invest in diversified cities with diversified economies and strong population in-migration and job market growth. Another important point to make is that the Yorkton Equity Group is both operationally as well as financially backed by the full capacity of the Yorkton Group of companies to fuel its growth. Okay, and another point I want to emphasize is we are not a REIT, so we have the full flexibility to reinvest profit back to growing the multifamily asset portfolio. As I mentioned, we have acquired in the past 6 months or so, we have acquired 7 months now, we have acquired 5 properties, and we intend to keep that momentum going. Our plan right now is to buy at least another 5 properties, so we have 10 properties in our portfolio for this year. In future years, we expect to increase that acquisition rate as time moves on. And finally, about 10 to 20% of our portfolio, we would like to rezone to higher densities so that we can sell the project and realize extra income for the Yorkton Equity Group to go and buy more apartment buildings and townhouse complexes. Okay. And finally, we have just begun to scratch the surface of the opportunities that await us in the multifamily rental space, especially in secondary markets across Canada. And we expect the growth in the real estate market to continue and to expand as we are expecting a post-COVID-19 economic boom. And certainly that will be reflected in the real estate market as well. Here's a chart showing how over time, debt decreases exponentially and how equity increases exponentially over time. And here you can see a $10 million property. This graph is showing $10 million property, perhaps doubling in about 30 years in Vancouver, as I showed you on this graph. If you look at the stock, the real estate prices in 2010 was just below $1 million. Today, you're looking at almost $2 million. So in the greater Vancouver market, this line here would be far steeper. It'll be going up like this, okay? So in a nutshell, what we have is an unprecedented opportunity to invest in real estate. We have historically low interest rates. We have mass immigration coming to Canada. And we also have a greater supply of building to choose from as a result of the pandemic. Perhaps some building owners were frustrated, and now they're putting a lot of product on the market. In our case, we're a seasoned property management team, so we're picking and choosing the best properties to put into our portfolio. Okay, so if you have any questions, feel free to contact me. I'm available 7 days a week. To reg@yorktongroup.com. This is my cell phone number. I'm available 7 days a week for phone calls. You can email our investor relations department at investors@yorktonequitygroup.com. Okay, so now I'd like to open up the floor for any questions.
Thank you, Reg. We do have some questions for you. Let's begin. So where do you see the largest growth, in commercial or in residential? And how will raising interest rates affect your answer and your margins?
I think the residential rental market is where we need to be, because we're going to see a significant, as I mentioned, significant migration of population coming into Canada, and all those people need places to live. And so the rental market is a lower risk market than the commercial market, and the rental multifamily rental market, it certainly is lower risk than commercial, and that's where we're going to see the big growth. As far as interest rates, we may see the interest rate go up, by small amount. We don't see any big interest rate increases coming in the next 3 years, certainly, maybe even after that, because all the economies around the world, including Canada, we're trying to recover strong from the post-COVID, from the COVID-19 situation. And so no, we don't expect significant increase in interest rates, even if the interest rates do go up. Yorkton Group of Companies, as I mentioned, has been operating since 1984, 1985 in the rental apartment building space. So we have seen interest rates go up and down. We have seen so many booms and recessions. We will deal accordingly, even if interest rates go up.
So where do you see, how are you currently capitalized? And are you making any acquisitions? Are you doing it with cash, stock, or a combination of both?
We've done two of the acquisitions that I showed you in the slide deck earlier, the 108 project and the Riviera Gardens 62-unit apartment complex. Both of those projects were acquired just using shares. The other properties that I showed you, like the Langford Victoria property and the Kelowna property, 19-unit luxury townhouse project property, those were acquired with cash. Okay, so we have raised our last private placement. We were planning to raise 2 million, and we ended up raising 2.825 million. Our first private placement was oversubscribed by over 300%. So we're in a good cash position. We're in a profitable cash position in 2022 and beyond. And we're planning to do our next private placement for $10 to $15 million. And that will be a broker private placement once this current private placement closes. So we have many buildings in the pipeline for acquisition in very strategic markets. I can't talk too much about the planned acquisition because they have not been news released yet. But I can tell you that as part of our business model, we will always have properties in the pipeline in the process of acquisition. Okay, that's part of our business model.
Reg, do you ever put any of your properties in Airbnb or those types of platforms? And if so, do you see them bringing higher margins?
We do not, typically list our properties for rent on Airbnb and so on. I think the Airbnb is suitable for perhaps smaller portfolios. In our case, we want to grow into a very large company. In fact, our plan is to grow this company, in the coming years, quite significantly. We will start to pay dividends once we reach about $1 billion in assets. Okay. So that's our growth plan.
Do you ever dividend to the shareholders after you liquidate a property?
No, once we liquidate, if we end up liquidating any properties, the profits will be put back to growing our multifamily rental portfolio. As I said, once we reach about $1 billion in assets, at that point, we will consider paying out in dividends. And the reason for that is we want to rapidly increase the net asset value, because as the net asset value increases, that will be reflected in the stock price. So our plan, our primary goal is to have growing net asset value, growing and stable net operating income. In a nutshell, we want to grow the net asset value exponentially over the coming years. That's our objective.
Okay. Another question from our viewers is, with real estate prices as high as they are right now, are you sitting back and waiting for them to come down, or are you investing at these levels?
Excellent question. In the single-family residential market, we're seeing prices very high. But in the multifamily rental buildings, perhaps because of the greater supply of buildings, as I mentioned earlier, we're not seeing those huge increases in apartment buildings like we're seeing in the single-family residential space. So there are two different markets. In the apartment building space, the prices are still quite attractive because there's a lot of supply on the market, because a lot of building owners were frustrated during the COVID-19 pandemic dealing with tenants. So we're seeing a greater supply of product on the market for us to pick and choose from. And perhaps as a result, we're also seeing very, very competitive, very good pricing. In fact, we can buy some buildings below market at the moment. So it's a little bit different from the single family house space.
Right. What about the single family?
Single family, especially I actually live in Vancouver here. Vancouver, the single family prices have gone up quite substantially. We may see a small pullback. I can talk about the Vancouver market. We may see maybe a 5% pullback over this fall, this winter. But come next spring, prices will be, back up higher than they were previously. We're expecting a post-COVID-19 boom because there's a lot of demand. We have very low interest rates, so any pullback will be short-lived because then we'll see money rushing back in because of the low interest rates.
Well, they're high here in the U.S. too. So what percentage of the cost of a property do you typically put down? And do you lend to or invest in third-party properties?
We typically put 25% down when we go to buy an apartment building or a townhouse complex. And no, we do not lend money to third parties. Our focus is to use all of our profits at the moment to purchase additional multifamily rental properties and grow the portfolio as rapidly as possible, increase the net asset value as rapidly as possible. And as I mentioned, as the net asset value increases, that'll be reflected in the stock price. And we want to make sure that investors that come in now will have a very significant return in the coming years. And remember, we're buying hard, physical, revenue-generating assets.
When do you think you'll go cash flow positive on a net level?
We are projected to be cash flow positive this fiscal year 2022. Right now, we're running a small deficit because we're doing some upgrades to some of our properties, like the Riviera Gardens. But next year, we're already in the positive.
Well, thank you so much for this presentation. We have a few more questions for you that we're going to send directly to you. Sure. And we look forward to hearing from you in the future about all your updates.
Thank you. Thank you very much for having me speak today.
All right. Thank you for your time. Okay, everyone, as we transition to the next presenter, remember you're going to see a black screen, but stay with us because we're coming right back.